You're in for a special treat today. We are going to go over a very important topic, especially in today's real estate market, which we know the market today is very hot. We understand that prices are going up across the country. And as investors, it's really important for us to understand appreciation, us to understand how to evaluate appreciation. And I want to tell you exactly who this training is for today to make sure you're in the right place. If you are an investor who is interested in owning a portfolio of rental properties, and maybe you haven't invested yet, but you've done your due diligence, and you're saying, hey, I want to invest in potentially this market over here, maybe in the Midwest. Potentially, I'm thinking about investing in my own backyard, which may not be a typical cash flow market. That's a common thought. And maybe you're considering investing in Jacksonville, which is a little bit different type of cash flow market. This training is geared for you. This is for those folks who are thinking about making a decision to invest in a cash flow market. And specifically, you're saying to yourself, well, I understand there are markets out there that have maximum cash flow, and I understand that there are markets out there that have more long-term growth, but I don't understand how to evaluate this growth, this appreciation factor. You have come to the right place. That is what we're going to be going over today. And specifically, our training is on home price appreciation in the Jacksonville, Florida market. And we're going to talk about what our predictions are for home price appreciation in Jacksonville, which is something you don't normally hear on trainings, right? People usually shy away from the word prediction, but there's a lot of data to back up what I'm going to show you here today. And I feel quite confident telling you how I invest and how I look at home price appreciation over the long haul, and when it doesn't factor into my decisions as well. So we're going to talk a lot about that today. I hope you're all excited. I'm certainly excited for you guys to be here. And with that, we are going to jump right into the presentation. I do want to make mention for all of us who are joining us on our live stream. We certainly are thankful you're here today. If you have questions, you have comments, feel free to add those. And during the session today, we'll be able to go over those comments and questions. And then for those who are on our webinar, you can post your comments in the chat box there, and we will do our absolute best to answer all of those on the call today. And if not, we'll follow up afterwards and make sure we get all of your questions answered. And with that, let's jump into it here. So let me get the slides going here. And boom, we are going to start from the beginning. So as I mentioned here, you are in the right place. If you are specifically looking for home price appreciation information in the Jacksonville, Florida market, how do I make that decision of where to put my money for turnkey rental properties? And away we go here. So I thought I'd tell you a little bit about myself. If I haven't had the opportunity to meet you in person yet, here's a little bit about me. So I am the co-founder and CEO of JWB Real Estate Capital. We are one of the nation's leading turnkey rental property firms. Myself, I own over 300 rental properties. I think that's important because anybody who is a turnkey rental property provider, in my opinion, should actually walk the walk, should actually own rental properties themselves so they can be the best resource and asset for you. And my business partners and I have been living this since 2006 and have acquired a nice rental property portfolio for ourselves, and happy to share all of the lessons and experience and training that we can to help our fellow investors out there. We currently serve over 1,000 clients who have purchased over 2,000 turnkey rental properties with us, and we manage over 3,100 rental properties. So a tremendous amount of experience that I'm happy to share with you today. We do manage over $350 million in assets, and we have over 80 employees here in JWB, here in Jacksonville, Florida. So the big thing is I want you to know that I speak from experience, and something that has been a passion of mine for a long time. And matching that with the relevant topic of appreciation today is what we're trying to capture. JWB has been blessed to win a number of awards. I'm not going to spend too much time talking about them, but we've won a bunch. I wanted to share them with you. The first one here that you'll see is fastest growing company. We have won the award for fastest growing company here locally, and we've been recognized nationally by Inc. magazine for every year, including 2019, which isn't up there. So we have consistently been able to perform at a high level. Best places to work is also something that's very important to us, Companies with Heart, a few of the awards. We were featured on the front page of the Wall Street Journal. They recognized us as being a pioneer in the space of brand new construction rental properties. So that was pretty darn cool. I'll tell you, when I saw us on the front page of the Wall Street Journal, the first thing I did was call my mom And I went out and bought about 1,000 copies of the Wall Street Journal. I don't know if that's ever going to happen again, but that was a pretty cool thing. And we've been actually recognized on the front page of the New York Times, Bloomberg, the Jacksonville Business Journal. So we're very well known locally, and certainly have had a great deal of success. But I'll tell you, the most impactful, the thing that I define our success on is how much we've been able to give and impact others' lives. And so out of everything that we have done for JWB, the single most important thing I think that has ever happened in our company history happened last year. And that is when we rallied our entire team, our network of contractors, our client base, and every other part of our network here in Jacksonville to do something truly impactful in the life of a wounded warrior. As you'll see here, we were able to build a brand new construction home and give it away to a wounded warrior who needed a helping hand after he had served our country. We do this through our nonprofit, which is JWB Cares. And this is a platform for us to do this annually. We plan to continue to do this annually. I'll tell you, the thing that I remember most about this experience was talking to this wounded warrior. His name is Rick. And Rick pulled me aside as we were giving him the keys to the home here. The news was there, the media was there. It was this fantastic celebration. And Rick pulled me aside and looked at me. And, you know, when a military man looks you in the eye, you certainly don't look away. But he had a combination of a little bit of tears in his eyes and the most stern look on his face. And he pulled me aside and he said, "Greg, you and your team are the type of people I would give my life for." And I'll tell you, that moment has stood with me every step along the way. It's the reason why we do what we do. And we would love to share that mission with you. We do with our current clients. If you're not a client yet, that's what we're all about. And so hopefully you feel that same type of purpose as well. And for those of us who may not stay with us the entire webinar, just wanted to let you know you do have an outlet to get in touch with us. An easy way to schedule a time to speak with us is just to go to this website, which is chatwithjwb.com. When you select a time there, you'll be able to speak with a senior member of my team, and we'll be able to have more in-depth conversations with you. So let's talk about what we're here to do today. And it all starts with what I have learned about rental property investors over the years here. Again, we've been in business since 2006. I've had the pleasure of speaking with thousands of investors, some that we serve as clients and some that I've been able to speak with at various conferences and just over the phone. And what I have learned about rental property investors is that they have no clue what to do with this thing called home price appreciation. It's like it is so easy to evaluate a rental property based on the rental income that comes in and to look at the expenses that are a part of the investment, that becomes the sole basis for the decision to invest, which is interesting. Because if you actually break down the return on investment of a rental property after a hold period of 10 years, 20 years, 30 years, a very long-term hold period, the biggest component of your returns is not that cash flow. Now, cash flow is important, but if you look at the biggest component of your returns over the long haul, it's not the cash flow. It's the home price appreciation. Right? But us as investors were a little bit scared because we saw what happened in 2008 and we're a little bit concerned. But the biggest thing is we don't know how to evaluate home price appreciation. So what we do is we just ignore it. But I'm here to tell you that that is the wrong approach. And the reason that's the wrong approach is because if you make your decisions solely based on cash flows and you ignore these other profit centers like tax savings and principal pay down and home price appreciation, you run the risk of costing yourself literally hundreds of thousands of dollars of lost opportunity returns that you won't earn simply because you didn't delve far enough to understand when you can count on home price appreciation. And so that is what we're going to focus on today. I'm going to arm you with the information so that you can go out and make the best decision for yourself, looking at all the facts, looking at cash flows, which I think are incredibly important. I don't want to minimize the effect of positive cash flow. That is crucial, but that's not the only thing to look at. We're going to look at specifically home price appreciation today. All sound good? Great. So let's talk about 2008. I know that still burns many of us. For those of us that were investing in 2008, it was a scary time. We saw the market fall 30, 35%. We saw home prices fall. And so what we have concluded, those that have lived through this, is, well, geez, the market might fall 35% next year. It might fall 35%, at some point again. It might go up, it might go down. I can't bet on when there is going to be home price appreciation, but I'm going to challenge that notion with you today. Question I get asked often is home price appreciation speculative, right? Is it, at the end of the day, is it something that I should count on as an investor? And my answer is, it depends, okay? There is certainly a time when I would not advise you to count on home price appreciation in your decision to invest, okay? That time would be if you have a short-term outlook. If you are buying a rental property today with the intention of selling that rental property in the next year, 2 years, 3 years, we should not be having this conversation about home price appreciation, right? This training is not for you. And the reason is because home price appreciation is speculative. I don't know what it's going to do over the next year, 2 years, 3 years. And even if you do get some great benefits of home price appreciation over the next 1, 2, 3 years, it really doesn't matter that much, because you're going to get eaten up with the selling costs and the holding costs of trying to dispose of the real estate. So this should not be a conversation. Home price appreciation should not be a conversation if you have a short-term outlook. But the alternative is what I want to talk about. If you are like me and you have owned rental properties for a long time, or your intention is to build a large portfolio to maybe replace income coming from other sources, or maybe to get your money out of the stock market into a more consistent asset class like rental properties are, and you do have a buy and hold time frame, a horizon that is 10 years, 20 years, even longer, then what I'm going to show you today is that it is not speculative. It is something that has tried and true metrics and data behind it. And there is a strategy and something that you can count on when it comes to your investment decisions. And this is the single greatest point where I think investors can benefit. If you do have that long-term buy and hold mentality and you are planning on holding a rather substantial portfolio, you need to listen up, because if you don't value in home price appreciation, that's where it can cost you tens and hundreds of thousands of dollars, depending on the size of your portfolio. The big concept that I want to share with you guys, I'm gonna bring this up many times in our conversations here today. You're gonna hear it many times as you speak with my team, is that home price appreciation, or HPA, as I'm gonna refer to it, HPA, the rates repeat themselves over the long run. When I came to understand this fact, it was like an epiphany for me, because it took this idea that home price appreciation was something that I didn't understand when it was going to happen, and it made it something that was really clear. And so as I started to delve a little bit deeper and to look into the data behind this, then it became even more clear that this is something I should make an educated decision on. And so I'm going to walk you today through the education that I went through many years ago to learn about home price appreciation, and why I continue to evaluate that in my buy and hold properties. And of course, that is what's led me to investing in Jacksonville, Florida, where clearly I have a bias because I own rental properties myself. I operate our business out of Jacksonville, Florida, but the data doesn't lie. And that's what we're going to look at today. Whether or not you're a big fan of Jacksonville or not, you're going to be able to get a lot of value out of this. But the key thing is, I want you to understand that home price appreciation, HPA rates, repeat themselves over the long haul, okay? The first bit of data that we're going to look at here. So for all of you number nerds like me out there, and all of you data and graph, and if you stay up late nights building Excel spreadsheets, you're going to love this. That's what I love to do, right? We've got our home price, our average home prices across the U.S. from 1988 to 2018, okay? The red line signifies what the average home price appreciation has been over the entire country. It's 3.75%. So that's that straight line that you see right there. The other data points are the average sales price, okay? The big thing you should take away from this graph is consistency, and that it doesn't sway too far away from the average, right? But I also want you to look at the time frames, right? If you go 10 or 20 years, you don't see a big swing in the prices. They come back to the normal, right? They come back to that red line, which is the trend line, okay? So what we're seeing is across the country, on the very macro sense, that's what you see, okay? Things come back to the normal. Home price appreciation rates repeat themselves over 10 or 20-year cycles. And that's what you see across the country. When you actually break it down on an individual market basis, though, that's where we're going to go next. And this 4.32% number is very important. Okay, if you're at home here, I want you to write this number down, 4.32%. Let's see, let's take some guesses from the audience here. So some who are throwing questions in or on Facebook or whatnot, what do you think 4.32% stands for? And we'll give it a little bit here before I share the answer here. And Kate, I know you're with me here. Let me know if we've got any comments coming up on Facebook about what 4.32% may be. We'll do a little, should we do a little Jeopardy music, like Final Jeopardy or something? You need to sing the Final Jeopardy theme song.
Yeah, I really do.
Let's see, we've got some questions, and just for everybody who's sending in questions, what I'm going to do in the interest of time is save those questions till the end. But we've got some guesses here. We've got some very bright people on the horn here. So home price appreciation, and one person guessed annual home price appreciation in Jacksonville.
Yeah, yes.
What else?
How much the market went up during some of the recessions, not 2008.
Very cool. That's a very good guess. I bet that person. So what that guess was how much the market went up in Jacksonville in the recession time? During some of the recessions. I feel like the listener there was reading our newsletter article or listening to some of our other trainings about what recessions have really done to real estate. That is a very good guess. That's actually not it though. If this 4.32% appreciation rate is the long-term appreciation rate for Jacksonville over the last 27 years. So one of our listeners here, let me give a little bit of credit to this person. Jonathan Felson. All right, annual home price appreciation. And Ron also said Jacksonville. So I think you guys combine your answers and you guys nailed it. So yes, the big thing here is 4.32% is the annualized home price appreciation rate in Jacksonville over the last 27 years. Okay, over the last 27 years is very important. That is more than one real estate cycle. And what we just shared is that home price appreciation rates over the entire country. And now what I'm about to show you over the individual MSAs or individual markets that you invest in come back to the norm as well. So if we know that Jacksonville's home price appreciation rate is 4.32%, that's a pretty high number. I'm going to compare that to other markets across the country, specifically cash flow markets, a little bit later in the training today. Let's take a look at what has really happened in Jacksonville since 2001. All right, it's 2019 right now. If I carry the niner, that's about 18 years. That's about a real estate cycle right there. And what happened from 2001 to 2019? Okay, did the market go way up? Did the market go way down? Did the market go right back up again, right? Have we had a lot of volatility? Absolutely, we had a ton of volatility, right? It would really challenge the notion that things come back to the norm, right? It would really challenge. Putting it another way, if things come back to the norm, going from 2001 to 2019 in a market, that's about the biggest challenge. You should really use that as a strong data point that things do come back to the norm. And that's what I'm here to show you. So again, look at this trend line now. This trend line is that 4.32% line that I just shared with you. That has been the average annualized home price appreciation in Jacksonville for the last 27 years. And we're taking a section now of 2001 to 2019. And those blue lines, the blue jagged lines up there, those are all the average, those are all the median home prices throughout those years. So you saw it go way up in 2001 to 2006. We saw the crash happen and up until 2011, 2012, and now we've seen it go back up. But if you look at it, we're touching that red line again in 2019, right? Things have come back to the historical norms in Jacksonville and in other markets across the country as well. So what this should show you is that you can count on home price appreciation trends over the long haul. And to answer the question that I proposed, or the topic of the session today is, analyzing home price appreciation in Jacksonville. What I'm here to tell you is the way I make decisions on my rental property portfolio is I plan to hold on for forever, at least 10, 20 years. And I expect that there's going to be roughly 4.32% appreciation, assuming that I hold on for 10 or 20 years, right? And the data would support that. That is such a crucial concept. So I hope that makes sense. We're going to put real numbers to exactly what that means and how that can how that should be evaluated into your decision in just a few minutes here. There is also a very strong link between home price appreciation and population growth. So I want to show you various data points, because the last thing I want you to do is to take one slide that this guy just showed you and have that be the basis for your decision-making criteria. Obviously, I'm showing bits and pieces of the equation for you today due to our time restraints. Happy to go in more detail with you when you jump on a phone call with my team. We can talk more about it. But I think it's on you to do more due diligence. And there's other data points for you to look at. One of those, in addition to what I just showed you there, so looking for long-term home price appreciation rates, you can find that, by the way. And I didn't have to pay for this data. It's all available through the government, right? Federal Housing Finance Agency is a website you can go to. That's where I pulled all that information that I just showed you on those graphs. Another place you can go and look at is the US Census to find population growth information. So why is population growth important, right? Population growth means if you have people moving to a certain area, everybody needs a house, right? So if you have a large percentage of people moving to an area, that's housing demand for both housing rental rates and home prices, right? We all probably know that. You didn't have to tune into this session to probably learn that, right? But that's important. If you look at a market over the long haul, again, that is consistently at the highest levels of population growth, what I'm going to show you here is that there's a very good chance that those population growth cities are also highest home price appreciation cities. Very cool. So let's look at the data here. Again, everything that I'm looking at here is from either the US Census or the Federal Housing Finance Agency. But we wanted to delve a little bit deeper and look at those cities. I've chosen 6 cities here. And I wanted to look at the home price appreciation from 1991 to 2018, and I wanted to look at the population increases, okay? I've chosen these 6 cities on purpose, okay? These are typical cash flow cities, okay? What I'm trying to arm you with today is the ability to make the best decision between those cities where you can get positive cash flow. Just because I shared with you that highest home price appreciations tend to come back to the norm over the long haul, that doesn't mean I want you running out to California or New York or some of those highly appreciating markets and go there, because what are you going to miss if you go to some of those markets? You're going to get home price appreciation, but the rental income is not going to support your expenses and you won't be in a positive cash flow situation. So the reason I chose these 6 cities, because these are 6 cities where, generally speaking, you have positive cash flow. And what I want you to do now is to go a step further and look at which cities are poised to appreciate more. And my theory and how I invest is you should put more of your assets in those ones that have higher appreciation. So let's look. Let's start at the bottom. Cleveland. For those of you who kind of follow us on Facebook and all of our live streams and a lot of my trainings here, I don't let a training go by where I don't make fun of Cleveland. And I've quickly realized that the clients that we have in Cleveland, I'm probably not going to get another client from Cleveland, but I am from Pittsburgh. I'm a huge Pittsburgh Steelers fan, and it just so happens that Cleveland's numbers don't look very good. I feel this 0% bad about talking about this with Cleveland. But the reality here is we're looking at the numbers. Population in Cleveland from 1990 to 2017 actually went down, right? People are leaving Cleveland. 24% decrease in population. That can't be good for rising demand. But something else to look at, Cleveland, home price appreciation. So even though population went down, that demand for housing in theory went down, home price appreciation still went up 2.4% from 1991 to 2018, over 27 years, right? That in itself shows you the strength of this asset class as a hedge against inflation. As the value of goods and services go up around real estate also goes up. So 2.4%, not bad, especially if a quarter of your people have left. If you go onward and upward here, take a look at it. Memphis is another popular cash flow market there. Their population increased about 7% from 1990 to 2017, and they experienced 2.7% appreciation onward and upward. And what you see, as I'm sure you're not surprised, knowing that I am completely biased because I do invest in Jacksonville, is that Jacksonville here is at 4.3% appreciation from 1991 to 2018. But look at this population increase. Population increased 40% from 1990 to 2017, right? You can also look at Dallas. Dallas is a very similar market to Jacksonville. It is one of those markets where you can still get positive cash flow, but population has been going up and home price appreciation has been going up, right? So hopefully this speaks to you. This is another data point that you can look at to evaluate the markets you should be investing in. All right, so what are the data points that we've looked at so far that you should be paying attention to? Should look for long-term home price appreciation rates. You can get that off of the government websites. The other thing you should be looking at is population growth. Again, you can get that off of the government websites, uscensus.gov, and start to compare these before you make the decision of where you want to invest. What I would urge you to do now that you're armed with this information is to take off the cash flow blinders. What I mean by this is to not get stuck into the easier way of making your decisions, the way that I would say most investors make their decisions, which is the easiest or most simplistic way. That is by simply looking at the rent to price ratio or the positive cash flow. I want you to look at all profit centers. I want you to look at cash flow first. I want to make sure that it's positive cash flow, but I want you to look at tax savings. I want you to look at principal pay down, which is your tenant paying the loan off for you. And I want you to look at home price appreciation. Now we're going to take a look. If you follow my advice, if you look at that criteria and base your decision on it, now we're going to put it into real numbers. Again, if you're a real numbers woman or guy out there, if you eat, breathe, and sleep real numbers here, we're going to look at this together because that's me here. And as I put these together, I thought, wow, this is mind blowing. I've got to share this, okay? So put yourself in the situation that you're considering between investing in Cleveland, Memphis, Kansas City, or Jacksonville for this graph here, okay? And you know that all these markets you can get positive cash flow, which means that the rental income is going to cover the expenses for that month. Now look at the choice of which is most likely to appreciate the most over the next 27 years. For you, look at this as over the next roughly 10 to 20 years for a cycle and tell me where you would put your money, okay? So here's the home price appreciation rates. Again, a little bit under 2.5% for Cleveland, all the way up. Jacksonville's a little bit over 4.3%. Now that you went through, we're gonna speed up this decision-making process. So let's say that you made the decision to invest in Cleveland, okay? And I want to share with you, if you invest in Cleveland versus Jacksonville, you are going to see a higher rent to price ratio. You are going to get more positive cash flow for the same dollars that you put out because properties there cost a lot less, right? You may get 25 bucks a month more, maybe even 50 bucks a month more, okay? But let's look at what the value of your total return on investment would have been in the long run. Because if you're like me, I'm not doing this for that extra 25 bucks a month. I am doing this for after 10 years or 20 years of holding on to this portfolio, I can look back and get the best risk-adjusted total return. That is what I am here to do. All right, so you purchased this property for $100,000 in 1991 in Cleveland. Today, well, excuse me, in 2018, as of this data, your property would be worth $188,000, a little bit more. That's pretty cool, right? Especially in an area where it went down, the population went down 25% or whatever that number was, right? That's pretty cool. That shows the value of this asset class, right? Not many stocks that consistently are able to produce that type of growth over the long haul across an entire marketplace, right? So you got 88 grand worth of equity. right? 88 grand worth of appreciation there. Pretty cool, but not nearly as cool as if you had thought about Jacksonville when you were making that decision. You took that same $100,000 that you invested in 1991, but you bought one property in Jacksonville. All right, let's do a little bit of Jeopardy theme music here. Do we have any guesses out there for what do you think that property would be worth in the year 2018? All right, we need some theme music, Kate.
I'm gonna Google it.
We're gonna Google the Jeopardy theme music here.
We're gonna bing it.
We're gonna bing it. Oh man, 350. And I've got some great comments here. I've got a Browns fan here, Jonathan. Oh man, you and I are gonna have a lot of discussions. I think, man, everybody's on the Browns train this year, man. You guys might have us according to the experts here, but I'm always gonna talk trash. So we've got Spezzo out there, guess 350. Pretty good guess. Pretty good guess. We've got a formula here. Somebody gave me 4.8% times 18. I don't know what that is, but not the answer we're going for. But I love the guess, and we'll keep. How's that theme music coming, Kate? Where's the theme music?
Beautiful piano.
If anybody has any Jeopardy theme music on the ready, you can send that over in the chat line. We're gonna keep. Oh, there we go. Dun dun dun. All right. Let's see if we have any guesses there. All right, good stuff. So if you purchased the same property for $100,000 in 1991 in Jacksonville, it would be worth $313,000. Doesn't make that $188,000 look that impressive anymore, does it? Right. So great guess by, I believe it was Spezzo out there, who guessed 350,000. That was some quick math by you. But hopefully you guys see what I'm talking about now, right? Armed with this information, knowing which markets are more likely to appreciate out of the small sector of cash flow markets, which markets are more likely to appreciate can have huge impacts on your returns. Your return from investing in Jacksonville over the 27 years there is just about 125 grand, okay? That should make you pay attention, okay? And the theory here is, yeah, you could get 25 bucks a month more in Cleveland, right? Or some of these other markets out there. But if you took 25 bucks a month times 27 years, it ain't close to 125 grand, right? And this doesn't mean that we have to go out and speculate and only bet on home price appreciation. We can invest in a market that pays for itself every single month, but is also positioning you to get the best total return in the long haul. If you can guess which market I think that is, it starts with a Jax and it ends with a Ville. If you follow us on our social media or on our blog, you'll find out that a lot of what I teach and train and coach on is not always the best return on investment. I don't feel like the reason I invest is because I want to make a lot of money. I feel like the reason I invest is because I want to have the opportunity to do what I want with who I want. And for me, a lot of it is my family, and I have 2 young kids, and I always want to be there to make sure that I'm there for their soccer games and coaching basketball and all that good stuff. And I know that whatever it is for you is very important as well. So one of the things that we love to do on our team, and one of the things we'll ask you in our first phone calls, is to understand what your why is, right? So be prepared when you do come to chat with jwb.com that we want to know a little bit more about you. You know, many times people will say that it is early retirement. I don't really let that one slide. That's kind of ambiguous, because retirement is sort of a situation. It's not what you do, right? What are you going to do when you retire? Are you going to travel the world? Are you going to donate your time and energy? Are you going to volunteer, right? Are you going to build up this portfolio so that you can pay for your kids' college funds or whatever it may be? We want to know what's driving you. And I wanted to share a story of 2 of our absolute favorite clients, because their why was such and is such a fun part to be a part of. This is Liz and Steve, and I put a picture here of their sailboat as well. Liz and Steve came to us and they had this amazing why. And they said, Greg, I want to invest because we're at a point in our lives where our goal is to build up enough passive income so that we can sell our primary residence use that money to go and buy a sailboat, and we are going to sail the world. But I can't do that with my investments in the stock market because they're way up and they're way down and they're way up and they're way down, and they would be an emotional wreck. And we said, that is awesome, Liz and Steve. We want to go on that journey with you because we know we can create consistency from the rental income here. So that's what we did. And so this is what it's like to be Liz and Steve. I asked them the other day, I said, when are you guys going to come back from traveling the world? I think it's been 3 years now. They've been traveling the world. They said, we don't know. And I thought that was really cool. So on our team, what we get to do is to really get to know our clients really well. You know, this is not a typical property management relationship, although we do handle your property management. We want to understand how to maximize your returns on your portfolio. So that means that we're going to have monthly phone calls to understand how your portfolio is performing. What are the changes that are going on in your life? Is this something that we need to adjust our goals, whatever it may be? And so I'll tell you, it makes it really tricky though, when somebody is on a sailboat traveling the world, to schedule time to speak with them. So every time that we want to speak with Liz and Steve on our monthly basis, they basically turn on the GPS on their boat and we find the nearest port that has Wi-Fi and we schedule it, and we get to have our monthly phone calls. And it's just been, again, so rewarding to help Liz and Steve get to that position there. I wanted to show you what their returns have really looked like, because I want this to become very real for you. You know, if you're listening to this story and you're saying, man, it might not be sailing across the world, but consistent income I could count on every single month would allow me to X. It would allow me to maybe find a job that I liked a little bit more than what I'm doing right now. Maybe it would allow me to scale back my hours from 60 hours a week down to 30 hours a week, or whatever it may be. This is the experience that we've been able to create for Liz and Steve. So their total capital that they invested was about $195,000. And this report here is something that we share with all of our clients. So I wanted to share their numbers with you. They, of course, gave me their permission. And we're looking at the returns just from the rental income, not from home price appreciation, okay? All of their home price appreciation is just a bonus on top, okay? But consistency, 2016, 9% returns from the rental income, 5% in 2017, 9% in 2018, 9% in 2019, for an annualized lifetime return of just about 7.85%. The really cool thing is we always keep track of what did we tell them in the beginning. So we went through this process and said, if we deliver 7.5% returns consistently for you, Liz and Steve, you are going to have a fantastic experience sailing around the world. And that expected annualized return was 7.5%. They're at 7.85%. As you can imagine, they are super stoked and enjoying the ride, literally. So again, for all of you who kind of think of yourself, somebody as maybe like Liz and Steve, maybe you want to travel the world, right? Maybe it is something different. For me, it's something different. For me, it is simply being able to have the time to be there for all the special moments in my wife and my kids' lives, and to never have to tell them no because there was something I didn't want to do. Whatever it is for you, I know it's really impactful. That's how we start the conversations. And with that, I see we have a few questions here. So I'm going to open it up to questions. For all of you who have questions, feel free to send those in. It's about 12:45 right now, so I'm not going to go too far over the allotted time that we had. Do we have any questions that we need to address on Facebook or whatnot? Just let me know if we've got a couple there. And if we don't get to your questions here, as we do have a number here, we will reach out afterwards. So Jonathan, REIT returns versus buy and hold properties over the long haul. So real estate investment trust, a REIT, so that's something that is much different than actually buying the asset. I don't have the long-term REIT returns right off the bat. I'm sure we could get that information to you in the short run here, but that's just a completely different asset. What I'd share with you is that, you know, REITs are it's a stock, right? It's a stock that is invested in real estate, right? Completely different than what we're talking about here. So when I'm talking about home price appreciation, when you actually own the asset, that's when you get to experience all of the benefits of that growth. In a REIT, right, as the values go up, obviously the value of that stock probably will go up, but you don't get that direct correlation. So it's a very different type of investment. I don't know what the long-term returns of a REIT are, but when you evaluate home price appreciation over the long haul, you're going to see that owning rental properties is going to be a higher long-term rate of return expected based on when you throw that home price appreciation. in there. And again, only value that assuming you're planning on holding for 10 or 20 years. Okay. Jim Tran. Hi, Jim. All right. Are these appreciations numbers per year? Yes. What I've been quoting with you, that 4.32% number, is the average annualized appreciation. So that is not saying that in 27 years that it is only appreciated 4%. That is saying average annualized, it appreciated 4.32% every year. So you can see the compounding nature of that. Thank you for clarifying that, Jim. I appreciate that. And we are 1 minute over, so I have 2 more questions that we're going to get to, and then we are going to wrap our conversation up today. What to consider as an out-of-state investor? Great question. Would you believe that out of the 1,000 clients that we have, almost all of those clients are out of state? So they choose to put their money in Jacksonville. Why do they do that? Well, number one, many times the market that they're in is not a cash flow market. There's only a handful of markets out there where you can get positive cash flow, right? Jacksonville, Cleveland, Birmingham, Memphis, some of those ones that I showed you are pretty common cash flow markets out there. If you live in California or New York, right, especially if you've been able to benefit over some of the equity building and home price appreciation you've seen over there, it's not like you can go next door and buy a rental property because they're going to be cash flow negative. So there are a lot of things to consider. Jonathan, that's a great question. What I would recommend is going to chatwithjwb.com because that's what we live and breathe, is serving those out-of-state investors. And it's really a much more in-depth conversation, but hopefully that gave you a little bit of insight there. Are your tenant placement fees one-time fees or recurring every year? Oh, that's another really great question. I wish we had more time. Maybe we'll do a training on it, but they are neither one-time fees and they are not recurring every year. What I would, and I'll explain that in a second, actually. What I would encourage you to do is go to chatwithjwb.com because you need to have a longer discussion on this. JWB does not subscribe to the model where we sign 1-year leases. That is typically the way things are done. We don't believe that's the best way to deliver a return on your investment. So we only sign 2- and 3-year leases, which creates this consistency like Liz and Steve were able to experience, and that creates consistency of returns. So tenant placement fees are charged every time you place a new resident in your home. If you're with a typical property management company, those are typically going to be every year because you only sign 1-year leases. With JWB, they're charged every time you sign a new lease, but we only sign 2- and 3-year leases, and our residents stay on average over 4 years. So that's 1 tenant placement fee on average over 4 years. All right, we have one last question, and I think Jonathan was the Browns fan. I don't know if I should answer this question. I'm just joking. Out-of-state investor and non-homestead exemption taxes, homeowners insurance on investment property versus primary. Whew, you're throwing a lot at me, Jonathan. All right. Non-homestead exemption taxes. So we're talking about investment property, right? So you're talking about non-homestead exemption. Taxes in Jacksonville, you'll find compared to other markets are relatively less expensive than other markets. That's a quick answer for you there. Homeowners insurance. We invest in new construction properties. New construction properties are going to have lower homeowner insurance costs as well. Generally in the $500 a year range is a pretty good idea. So really low for new construction, which is what we focus on. And Jonathan, thank you. Jonathan said, thank you. Great webinar. Thank you all. And we will catch you on the next one.